Hi, I'm Cliff Ennico, legal and tax editor of itsyourbiz.com with some thoughts on buying a business. So you've been looking to buy a business for a while and you find the perfect candidate. It's a great business, got a great location. The numbers all look solid. The seller's a great person. He's looking to retire down south. He's quoted you a very affordable purchase price, and he's even willing to take back paper. He's even willing to let you finance pay a portion of the purchase price over time. All the arrows are looking up. This looks like a done deal. And then the seller pulls you off to one side and says, you know, now that I feel I can trust you, there's something I really need to tell you. Wink, wink, wink. I've been really keeping two sets of books on this business for some time now. And, you know, there's a set of books for the government, and there's a set of books that shows you what the business is really doing. Now, obviously, I want my purchase price to be based on the private set of books, the books that tell you what it's really doing. I don't want to base the business on the purchase price on what I'm telling the government. I'm hoping that that'll be acceptable. Well, of course, that's not really acceptable. I mean, what the seller has just done here is he's admitted that he's been committing fraud and doing all kinds of things. He's basically been cooking his books and lying to the government, his creditors, and God only knows who else. It'd be very easy in a situation like this to say, well, just walk away clean. Don't deal with this person. He's obviously a no-goodnik. If he's lying to the government and to everybody else, what are the odds he's being straight to you about all the other stuff he's been saying? You know, but that may not always be the best advice in a situation like this. If the business is truly solid, if it's truly performing well, and if you feel comfortable that you can run the business the right way and still make money without having to do the two sets of books, it might be a mistake to walk from this deal. But you should try to protect yourself. Now that you're on notice that the seller is lying and playing games, you got to work extra hard to make sure that you don't get caught up in any of his nonsense. And there's three basic ways you do that. Number one, due diligence, lots and lots of it, twice as much as you would do if that conversation had not happened. Get an accountant, what we call a forensic accountant, to tear apart both sets of books, put them together 10 ways till Tuesday, and find out if that second set of books is really for real. Because if he's lying about the first set of books, he might be lying about the second one as well. A good forensic accountant can help you with that. Secondly, work in the business for a while. Spend a month or two and work behind the cash register. See what the sales actually are each week and compare them to what he's reporting on both sets of books and see which one is for real. You know, don't trust the books. You know you can't rely on either set of books, so get the information yourself and see which set of books is the truth. Spend as much time as you can. Do not close a deal like this fast. Spend at least a couple of months living in the business and finding out what's real and what isn't, since you're on notice that the seller is playing games. Second thing you have to do is base the purchase price on the government set of books, the public set of books, the lower set of sales figures. Never base the purchase price on the higher private set of books. Always base the purchase price on the public figures that are publicly available. That's a conservative position, but it also protects you in case anybody ever comes after you and says that, you know, hey, wait a minute, you based the purchase price on inflated figures. Why did you do that? Now the seller, of course, will not like this because he wants the purchase price to be based on the second set of books that shows higher sales. There's a way you can get around that. What you can do is you can give the seller an equity kicker. This is a percentage of sales over a certain amount. So what you would do is you would base the purchase price on the public set of books, but you would put a provision in the contract saying that if monthly gross sales exceeds 110% of what's reported on his books, on what his historical figure is for the last year, you will pay 10% of the extra gross sales to the seller in addition to what you're paying under your promissory note for the portion of the purchase price that he's taking back paper on. That's called an equity kicker. That way, you're basing your purchase price on the most conservative information available, yet the seller does get to participate in the upside of actual performance due, wink, 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 to the wonderful and excellent way in which you're running the company now is creating excess income. That's the way to get around that. And then thirdly, and most importantly, make sure that you are not caught up in the seller's web of deceit. If you buy this business and somebody comes down on him because he was lying, you want that to be his problem, not yours. You want to take over this business business clean. And there are a number of ways you can do that. First of all, you should always buy the assets of the business. You never ever buy stock in the seller's company. You always buy the assets. When you buy the assets of a company, you only assume the liabilities that you want to assume. You do not assume any other liabilities whatsoever. So, for example, you definitely want to assume his lease of the location that he has because it's a great location, but you do not want to buy into any of his tax liabilities. Buying the assets of the business will help you get around that. Number two, a lot of state government agencies will give you clearance letters for various types of taxes, especially sales taxes, use taxes, and payroll taxes. In many states, even if you buy the assets of a business, the state will hold you personally accountable if the seller has been shortchanging them on sales taxes and payroll taxes. But when states do that, they will always give you a procedure. It's known as a clearance letter, where you basically can apply to the state for this piece of paper, which basically says, look, we know you're buying this business. We've looked at the seller's books. We think he's okay. We will say that, if we discover that he's been playing games with us and he owes us money, we will deal strictly with him. We will not chase you down for anything that he may have done. That's called a clearance letter, and you should always ask for these as a condition of closing, especially in a situation in which there's what we call transferee liability, where the state can chase you down for things that the seller did wrong. Now, obviously, if there is no clearance letter procedure available, or if the seller will not let you get a clearance letter from a government agency and there is transferee liability, at that point you should walk from the deal, because you do not want to have personal liability for anything that the seller may have done, especially since you now know about it. But if you can get the clearance letters, and if you structure the deal as a purchase of assets, you can at least sleep at nights that any problems the seller have will stay with the seller, and that you will not suffer because of the things that he did wrong. I'm Cliff Ennico for It'sYourBiz.com.